Greetings, everyone. Scott Richardson and Dan Brown from Richardson Capital Management here to provide the economic and investment update for July 2021. The financial markets were a bit mixed in July as large cap U.S. stocks and developed international stocks were positive for the month, while small cap U.S. stocks and emerging market stocks were down slightly for the month. The S&P 500 had a little bit of a choppy month as it was down in the middle of the month as there were concerns regarding the Delta variant of the coronavirus. But by month end, those concerns had alleviated and the S&P 500 hit record highs. Speaking of the Delta variant, I'm going to turn it over to Dan to provide a little bit of commentary on that front.
Thanks, Scott. So we saw mid-month that COVID-19 cases surged quite a bit, and this caused stock market to dip in the negative territory for a couple of days. But then we saw that hospitalizations and the death rate associated with the Delta variant really wasn't concerning, so stocks rebounded nicely. And one interesting data point that we saw is from U.S. airline CEOs basically state that in spite of the surge in Delta variant cases, that their bookings for their airlines were stronger week over week, pretty much every week of July. So we take that as a positive case that investors aren't terribly concerned about the Delta variant and its impact on the economy. And we don't think this will lead to further shutdowns or lockdowns. So Scott, we had a Fed meeting last week. Any takeaways for our clients?
Yeah, so as everyone knows, the Fed has been very accommodative and they reduced interest rates and have been purchasing $120 billion worth of bonds on a monthly basis in an effort to keep interest rates low. And the Fed indicated last week that we are getting closer to the point where such accommodations won't be necessary, but they are going to continue as is for the time being. Our take on it is that by the end of the year, they may start tapering or cutting down on the amount of the bond purchases. But they did make it clear that interest rates are going to remain low for quite a while. Dan, have you got some thoughts for us on inflation? Because we know there's inflation concerns, especially as it relates to what the Fed has been doing.
Yeah, there's definitely inflation out there, and the Fed's acknowledging that. They still largely believe it will be transitory. Some of the components that are leading to the surge in inflation should be temporary in nature. So, for example, used cars, new cars, hotels, car rentals, and airfare have all surged recently as the economy reopens. We don't think this is sustainable. In fact, we're seeing that used cars for the month of June surged by 10.5%. And we're already seeing that at the wholesale level that used car prices are rolling over. So again, we're not terribly concerned about inflation and expect it to be largely transitory. And Scott, we saw second quarter GDP reported last week. What did we learn from that?
Yeah, I'll just give a couple quick highlights. Basically, the GDP in the second quarter came in at 6.5%, and the expectation was for 8.4%. So it disappointed by a little bit, but the reality is that's still an extremely strong reading. We would expect to see continued strength in GDP throughout the rest of the year as the economy continues to recover from the shutdown from last year.
Sort of an outlook for the rest of the year, we still remain positive on the stock market. We think earnings growth will continue into the second half of the year. Companies are almost done reporting second quarter results. We think as we go from second quarter to the third quarter, we'll see a deceleration of earnings growth, but still be very positive in the third quarter and fourth quarter. So we take that as a positive signal. And as Scott alluded to, there were some shortfalls in GDP. A lot of that was due to the bottlenecks in the different supply chains. We think that'll actually push out growth into later this year and early next year. So still some very positive accommodative signals. And we still think there's more support on the fiscal side out of Washington, D.C., namely in the form of an infrastructure bill, which would be about $1 trillion in spending. So still very supportive all the way around with monetary policy, fiscal policy, and earnings growth.
With that, I want to thank everyone for joining us. As always, if you have any questions or concerns, please don't hesitate to reach out to us. Please feel free to forward this to any friends or family that might benefit from hearing it, and sign up for our channel to receive future updates. And with that, we thank you.